What if I told you that the perfect investor, the one all financial models are built around, doesn't actually exist? For decades, economic theory has revolved around a figure known as Homo economicus, a perfectly rational being who makes every financial decision with flawless logic and complete information. This individual weighs every pro and con, calculates probabilities with the precision of a supercomputer, and is never swayed by emotion, popular opinion, or gut feeling. They are the ultimate optimizer, always choosing the path that maximizes their wealth and minimizes their risk according to cold hard data. The problem, of course, is that you and I are not Homo economicus. We are Homo sapiens. We live in the real world, a place filled with incomplete information, confusing signals, and the powerful pull of human psychology. Our decisions are shaped by stories, by the behavior of our neighbors, by our hopes for the future, and by our fears of repeating past mistakes. We get excited when markets are booming and terrified when they crash. We anchor our expectations to recent events and often overestimate our own ability to predict the future. This gap between the idealized rational actor and the real living, breathing investor is the single most important concept you can grasp to truly understand financial markets. The financial models that assume perfect rationality are like a map of a city that has perfectly straight roads and no traffic. It's a useful starting point, a clean and elegant way to think about the landscape. But once you get in the car and start driving, you quickly realize you need to account for traffic jams, unexpected detours, and the sometimes erratic behavior of other drivers. The neat lines on the map give way to a much more complex and dynamic system. Understanding this difference is not just an academic exercise, it is the key to navigating the real world of investing successfully. So, as we explore how to build a smart portfolio, we will constantly dance between these two worlds. We will look at the elegant logic of financial theory, but we will do so with a healthy dose of skepticism, always asking, how does this hold up when human nature enters the equation? We will learn the rules of the game as the theorists see it, but we will also study how the most successful players actually win. Our goal is not to become unfeeling robots, but to become more aware humans. Investors who understand their own biases and can navigate a market driven by the collective psychology of millions of other equally irrational people. This awareness is your greatest asset. Have you ever faced a choice that seemed simple on paper but felt complicated in your gut? Imagine you have some money to invest and you're presented with two government bonds. Bond A is a US Treasury bond offering a 5% annual return. Bond B is a bond from a stable, friendly foreign country, also offering a 5% annual return. For the sake of this example, let's assume that after accounting for currency exchange rates and credit ratings, objective analysis concludes both bonds carry the same level of risk and identical expected return. Which one do you choose? A perfectly rational investor, our old friend Homo economicus, would be completely indifferent. Since the risk and return are identical, there is no logical basis for preferring one over the other. The choice is a coin flip. Yet, study after study shows the vast majority of American investors will overwhelmingly choose the US Treasury bond in this scenario. They might justify their choice by saying it feels safer or that they know it better. This phenomenon is known as home country bias. It is a clear, predictable, and entirely irrational preference for the familiar over the foreign, even when all the data says they are the same. This simple example reveals a profound truth about how our minds work. We are not just calculating machines, we are storytelling machines. The US Treasury bond comes with a powerful narrative of safety, stability, and patriotism. It's the investment our parents and grandparents trusted. The foreign bond, no matter how safe it is on paper, lacks that same rich, comforting story. Its narrative is unfamiliar. Do you remember the late 1990s? It was a time when it seemed like a new internet millionaire was being minted every single day. The narrative was intoxicating. The new economy had arrived. Old rules of valuation no longer applied. Companies with no profits, no clear business model, not even a finished product, were going public, and their stock prices soared. Fear of missing out outweighed fear of losing money. A rational investor would have looked at pets.com. It was losing money on nearly every sale, and its sky-high valuation was unsustainable. They would have analyzed cash flow, competitive landscape, fundamental business prospects, and stayed far away. But the market is not a single rational investor. It's a crowd. Crowds are susceptible to manias. The story that the internet changed everything became more compelling than the numbers. When your neighbor, your brother-in-law, and the expert on television all say the same thing and seem to be making a fortune, it's hard to trust dissenting analysis. We are herd animals. We follow the herd, especially when it appears to be running toward a field of green. The bubble eventually burst in 2000 and 2001. The dazzling narratives evaporated. Investors faced balance sheets and burn rates. Trillions of dollars in shareholder value vanished. The same people once hailed as geniuses were now seen as victims of a speculative craze. The dot-com bust was painful but invaluable. It taught us collective belief can create temporary reality. Eventually, fundamentals matter. Stories can only carry a stock so far before financial gravity reasserts itself. Here's a phrase every seasoned investor knows by heart: the market can remain irrational longer than you can remain solvent. Imagine you were one of the few rational analysts in 1998 who correctly identified the dot-com bubble. You decide to short sell a basket of overpriced tech stocks. Short selling is a bet that a stock's price will fall, but here's the catch. In 1998, you were right in theory, but the market kept going up, and it kept going up through 1999. As the stocks you shorted climbed, your position became precarious. Your broker demands more collateral. Your friends are buying and laughing. You feel certain you're right, but your bank account says you're going bankrupt. If markets can be so irrational, why do we bother with financial models at all? Well, let's start with one of the most famous of them all, the capital asset pricing model, or CAPM. At its heart, CAPM asks, how much return should I expect for taking on a certain amount of risk? It provides a beautiful, clean, and logical formula. The model says expected return equals the risk-free rate plus a bonus for market risk. The risk-free rate, think a super safe short-term government bond. The second part is beta, a stock's volatility relative to the overall market. The market as a whole has a beta of 1. A stock with a beta greater than 1 is more volatile. Think of a high-growth tech stock. A stock with a beta less than 1 is less volatile, like a stable utility company. According to KPM, higher beta means higher expected return. Suppose the risk-free rate is 3% and the market's expected return is 10%. The market risk premium is 10 minus 3, which is 7%. Stock A is a stable food company with beta 0.8. Expected return equals 3% plus 0.8 times 7% equals 8.6%. Stock B is a more volatile software company with beta 1.5. Expected return equals 3% plus 1.5 times 7% equals 13.5%. The model gives us a precise, logical number. In a perfectly rational world, every asset would sit on the security market line. So, if CAPM provides such a neat and tidy blueprint, why doesn't it perfectly predict stock returns in the real world? The answer lies in the heroic assumptions the model makes about the world and about us, the investors. First, CAPM assumes that all investors are rational optimizers, just like our old friend Homo economicus. As we've seen from the dot-com bubble and home country bias, this is demonstrably false. People make decisions based on emotions, stories, and social pressures, not just on a cold calculation of risk and reward. Second, the model assumes that all investors have access to the exact same information and that they all interpret it in the same way to form identical expectations about the future. One investor might see a company's earnings report as a sign of strength, while another sees it as a warning of future weakness. Furthermore, some investors have access to better information or more sophisticated analysis than others. Third, and perhaps most critically, CAPM assumes that investors can borrow and lend unlimited amounts of money at the risk-free rate. This is clearly not true for the average person. While a massive financial institution might be able to borrow at rates close to the government bond rate, you or I cannot. When we borrow money to invest, we do so through margin loans that carry much higher interest rates and stricter conditions. This real-world constraint fundamentally changes the choices available to us. The blueprint is elegant, but the construction site is messy. Understanding these limitations is crucial. It prevents us from treating a theoretical model as infallible gospel. If CAPM is built on flawed assumptions and doesn't perfectly predict the future, you might be tempted to dismiss it entirely. This would be a mistake. A map doesn't have to be a perfect replica to be useful. A simplified model can provide immense value by giving us a framework for thinking. The true power of CAPM isn't precise target prices, but the fundamental concepts about risk and return. It forces you to think like a sophisticated investor. The single most important lesson: risk and expected return are inextricably linked. You cannot expect high returns without accepting high risk. So how do we take these ideas and use them to build a smarter portfolio in the real messy world? The goal is not to find the one perfect stock, but to assemble a collection of assets that work together. This is the art of portfolio optimization. The expected return of a portfolio is simply the weighted average of the expected returns of the individual assets within it. If you have 60% in stocks expected to return 10% and 40% in bonds expected to return 5%, your portfolio's expected return is 0.6 times 10% plus 0.4 times 5%, which equals 8%. The risk part is more complex, but far more interesting. This is where the magic of diversification comes in through covariance. Covariance measures how two assets move in relation to each other. If two stocks are in the same industry, they likely have high positive covariance. But if you combine an oil stock with a renewable energy stock, their covariance might be lower or even negative. By combining assets with low or negative covariance, you can dramatically reduce overall volatility without sacrificing much return. This is the only free lunch in finance. When investors sell stocks and rush to bonds, this negative correlation helps cushion your portfolio during downturns. This brings us to the efficient frontier. Imagine plotting every possible combination of assets with risk on the horizontal axis and return on the vertical axis. The efficient frontier represents portfolios that offer the highest possible expected return for a given level of risk. Your job is to identify this frontier, then choose the point that best matches your personal risk tolerance. We have journeyed from the sterile logical world of rational economic theory to the chaotic emotional reality of the trading floor. We've seen how elegant models provide valuable blueprints and how human behavior systematically deviates, creating both peril and opportunity. So, where does this leave you, the individual investor trying to secure your financial future? The ultimate lesson is one of intellectual humility and psychological self-awareness. Becoming sophisticated is about understanding that the market is a complex adaptive system driven by the hopes and fears of millions. It is about recognizing that you too are susceptible to the same biases: overconfidence, herd behavior, fear of missing out. The best defense is not a more complex algorithm, but a deeper understanding of yourself. This means building a robust process and sticking to it. It means constructing a diversified portfolio based on sound principles of risk, return, covariance, and efficient frontier. It means having the discipline to rebalance periodically rather than chasing the latest hot trend. It means treating financial models as useful compasses, not as infallible GPS systems. Successful investing is an act of rebellion against our own worst instincts. It is the triumph of long-term planning over short-term gratification, of discipline over impulse, and of quiet analysis over the noisy crowd. By embracing the tension between rational theory and behavioral reality, you move beyond what should I buy to what kind of investor do I want to be. Answering those questions is the true path to becoming financially wise.